Thank you for tuning into this NBI podcast. Last week, we talked about the war in Ukraine, its implication on commodity prices and inflation in general, and also the broader impact of supply chain issues. This time around, we're going to talk about market implications from an investor's point of view. And to do that, my guest today is Jacob Jolly, Senior Investment Strategist at BNY Mellon. Jake, welcome and thank you for being with us.
Thank you for having me.
Jake, why don't we start by assessing the state of the markets? Can you tell us how global markets have reacted so far after a month of war? And in your mind, are there any particular market moves worth highlighting?
Yeah, certainly. So I think the initial market reaction was a pretty clear flight to safety. We saw equities decline, bonds rallied, gold and the US dollar rose. Just to give you a few numbers here, in sort of that first week and a half after the invasion on February 24th, the German DAX, so blue chip German companies, declined more than 10%. The stock 600, a broad measure of European equities, it declined over that same period about 8%. And of course, this was not just a Europe story, because on a global scale, the MSCI All Country World Index, so the ACWI, so broad, the broadest measure of global equities, it was down about 4%. At the same time, we saw that sovereign yields, they came in briefly, but then kind of pretty quickly continued their upward trend, which we had characterized much of the year. And lastly, and probably most importantly, we saw that commodity prices reacted very strongly. So this makes sense given Russia's significant role in global energy and commodity markets. Brent crude oil price increased by about 40% in this first week and a half. Through March 8th, the Bloomberg Commodity Index was up about 15%. Now, where does that leave us today? We're about 1 month out from the start of the war. Losses in equity markets have largely been recouped. So the MSCI ACWI is up about 4% on its February 23rd level. The stock 600 is flat. The German DAX is down, but only by about 2%. The continued fluctuations in oil prices has been sort of the major driver over this period, which makes sense just given the particular sensitivity to a risk of prolonged elevated energy costs that could certainly dampen the global growth outlook. And at least in my mind, right, that extreme volatility is illustrative of just how uncertain this situation is. Sanctions have been evolving very rapidly, and the market is, to be frank, struggling to work out sort of expectations around supply over not just the near term, but the medium term. And just to really briefly kind of summarize how volatile the oil price swing has been, we came into this year with fairly tight global spare capacity, and crude oil was at about $70 per barrel at the end of November last year. It had increased to $90 per barrel in early February. Upon the invasion, oil jumped to $105. Sanctions were being announced. Companies were starting to self-sanction and avoid Russian crude. And we saw oil push even higher. And at March 8th, we were above $130 per barrel. So a very significant jump over a pretty short amount of time. But it's really swung since then. OPEC officials came out saying that they were, favorable to attempting to boost capacity or boost supply faster. Oil pretty quickly came down back to $100 per barrel, but has since again retraced, went back to 120, has since come back. I was checking this morning, we're around 110. So it's really been a roller coaster, but certainly even at sort of the 110 mark, we're pretty significantly up for the year. And what I'm seeing is that we are seeing a growing willingness on both sides to use energy supplies as a tactic, as a weapon within this conflict. And sort of the latest headline there is that Russia is planning to demand payments for its natural gas to be made in Russian rubles. We'll see kind of what comes of that. But I think at the end of the day, it's a very fluid situation, and it's not likely that oil markets are going to settle down anytime soon, and that's going to have knock-on effects for global equities.
I understand. So speaking of equities, you mentioned that equities had recouped almost half of the losses that were incurred since the beginning of the war. Could beforehand markets have drawn any parallels with what happened in 2014 with the annexation of Crimea? Or it's a totally different conflict?
Yeah, it's a great question, and it's actually one of the first things I did on February 24th when I logged on to Bloomberg. I took a look there, and unfortunately, even on that first day, it seemed that this conflict was going to be much more severe than the Crimea annexation. So, as a quick refresher, that invasion took place in February of 2014, but it was much smaller on a military scale. Was short-lived. It was only about a month in terms of its military operations and very few casualties. So it really doesn't even begin to compare with what we've seen in Ukraine over the past month. And I think maybe most importantly, that the sanctions that came out of that period were far less severe and far-reaching. Markets never really seemed to be concerned that Russian oil was going to be removed from global markets. So you didn't see anything like the market volatility that we've seen in the past month. So I think today's conflict is, orders of magnitude different, and certainly in our view could be a major reset of geopolitical relationships, not just with Russia, but China as well. And unfortunately, I think that we're still in the very early days in terms of the true extent and impact of sanctions on financial markets, as well as with the conflict. We obviously all hope that a negotiated ceasefire is sooner rather than later. But I think that unfortunately we're still in potentially early days, and that could hang over markets for some time.
Yeah, I think you're absolutely right. This conflict seems to be going nowhere, with the Ukrainian army offering much more resistance than what I guess Russia was hoping for. What would be the implication for markets of a drawn-out conflict?
Well, it's certainly a risk that the longer the conflict drags on, months, years, hopefully not, but it would certainly increase the risk of severe consequences for global economies. And that's primarily due to the energy price channel. Energy prices could remain elevated for much longer, and that has significant consequences for global aggregate demand. Our team, we focus on analyzing probabilistic scenarios, and one of our main scenario paths right now, unfortunately, is this protracted conflict. We think that unfortunately it does deserve a meaningful probability at the moment. Now, Russia is small from a global GDP perspective, but it is critical from an energy and commodity supply perspective. The OECD has actually already come out and has some estimates that suggest that if the commodity and financial shocks that we saw in those first 2 weeks, if those were to persist over the next year, global growth could be reduced by 1%. And inflation could actually increase by more than 2.5%. And unfortunately, we think that that's probably even optimistic. We think that if mediation fails to diffuse the fighting, global energy supplies are going to remain at risk, and that certainly, raises the risk of severe consequences, particularly for those European economies, given their reliance on Russian energy imports.
What type of a probability do you put on such a scenario? You have a number?
I do have a number. So we have it at about 35%.
Okay.
And I will certainly point you to our publication, which lays out, it's a nice probability tree. And, we are, economists and financial analysts. So we are essentially, not taking a view on whether the conflict will be short and contained or long and, protracted. So we start our first step of our probabilities for this review is basically saying, a 50-50 probability either way. And this protracted conflict, we certainly think that it has risks to not just energy markets, but more broadly to commodity markets, because we could see it impact global production, of metals, and we've already seen some disruption within commodity markets. Nickel being kind of the one that everyone's been reading about. So again, it's a meaningful probability. Certainly, it's not the one that we hope to see, of course, but the long story short here is that we could see inflation push higher from here. It could stay higher for longer, and ultimately that could hit real incomes, and particularly in those energy importing economies, that's going to result in a slowdown in world GDP.
Jake, you mentioned that, well, everybody knows that Russia is in a very dire situation right now with all of those sanctions. And one of the impact was that MSCI decided to take Russia out of its emerging market index. What would be the implications for global investors in your mind?
Yeah, so just a quick recap. So on March 2nd, MSCI reclassified Russia from its emerging market status to a standalone status, so essentially stripping it of sort of being an emerging markets for index purposes. And this was following consultation with asset managers and recommendations that essentially the Russian market had become uninvestable. Now, first off, this is kind of a good reminder that index construction is a much more active process than many people give it credit. Often indexes are thought of as being, these passive, broad market exposure, and that is true in many instances, but certainly index providers do have discretion over what is in the index, and this is a good reminder of how that can change pretty quickly. So fortunately, the Russian equity market is relatively small. It was obviously much smaller post invasion as the market essentially collapsed and trading was frozen. We're only actually now seeing that equity market start to open up again, and now with new restrictions on trading. But if we go back in time, the weight of Russia within the emerging market indexes has actually been declining for some time. So back in 2007, it represented about 10% of the MSCI Emerging Market Index, but coming into this year, it was only about 4%, and that's an even smaller percent when you look at global benchmarks. So on a global basis, it's something like less than 50 basis points, so relatively small. And from that perspective, removal is going to modestly increase the weights of the remaining constituents, but it wouldn't be expected to be overly disruptive from sort of an index tracking and performance perspective. That being said, for investors that do or did hold Russian securities, certainly there are going to be difficulties in closing out those positions. Many times, they might be already marking those securities at zero. And if they are eventually able to divest, it may come at a significant discount. So certainly a difficult period for those managers with significant Russian exposure.
Yeah, the heavyweight of that emerging market index is clearly China, and with the development of the new world order with different economic poles, would China, in your mind, be one of the would benefit of all of this noise surrounding the current conflict?
Yeah, and it's a great question, and I certainly don't think I will do it justice here in sort of covering it in a couple of minutes. But I will try to summarize what I think are some of the key developments. Very early on, after the invasion, Chinese stocks sank as sanctions were rolled out. And I think the speculation there was that U.S. sanctions were going to adversely impact China, given China's alignment with Russia. Now, Chinese authorities came out pretty quickly and tried to separate themselves from the crisis, and they were emphasizing pretty clearly that they do not want to be adversely impacted by sanctions. Of course, I don't think Chinese companies are going to go out of their way and tell everyone that they're complying with sanctions, but at the end of the day, I think that they will be complying with global sanctions. And reportedly, we're already seeing that Chinese buyers that had initially shunned Russian shipments of coal, liquefied natural gas, as well as crude oil, that was temporary. And it's now being reported that China's independent refiners are starting to buy Russian energy products through private negotiated deals. But again, continuing very cautiously. And sort of what I'm hearing is that there's no evidence that Chinese companies are attempting to avoid sanctions. And while Russia depends pretty heavily on China as an external trading partner, China is simply much more connected to the US and Europe as being key markets for its products. So, my view here is that China is probably going to try to walk a fine line of, continuing to diplomatically support Putin and Russia. But from sort of the business and financial ties, they're just far too important to risk by overstepping or pushing back on sanctions, too much. So, and that comes particularly in light of the domestic situation in China, right? We've sort of been describing it as this triple headwind of the zero COVID policy, which is going to be difficult, is already showing how difficult that is to manage. And then combine that with the ongoing slump within the property market, and then weakened confidence stemming from the crackdown on the tech sector last year. So those are all headwinds. The growth target for this year in China is probably overly ambitious. So I think overall, China is going to make the decisions that are best from sort of the economic standpoint for China.
Yeah, that's definitely something that we'll have to keep monitoring very closely in the near future. Another thing that I guess we'll need to monitor, we always look at war or conflicts in isolation, but depending on where we are in the economic cycle, it could have different impacts. And nowadays, with inflation picking up, it's certainly had an impact on monetary policy expectation. Does the war change how global central banks are handling monetary policy, you think, this time around?
Well, I don't think their jobs are getting any easier. Historically, central banks have taken this view that they should look through exogenous price shocks, such as the one that we're seeing within energy markets. The general idea here is that they try to leave policy largely unchanged and delay any major policy decisions until uncertainty resolves, or at least there's a bit more clarity on sort of how the external shock's going to play out. Now, that is generally because they try to focus on medium-term expectations, right? They're not looking to manage month-to-month volatility, and certainly their target, their mandate, globally tends to be focusing on that medium-term inflation expectations. Of course, we're sort of not in a normal environment, as you've already alluded to, right? We are facing inflation that is meaningfully above target in many countries. Some of them have extremely tight labor markets, and there's already considerable nervousness around sort of this shift upward in inflation expectations. And ultimately, that's leaving very little room for central bankers to maneuver through this current crisis. So to us, that means that there's certainly a risk that central bankers, take a different tactic this time around. So if we see a situation where energy prices remain high or even spike higher from here, and that ends up being a concern for those medium-term inflation expectations, we could find ourselves in a very challenging situation where central banks are tightening into a slowing economy. That's certainly a situation that central bankers want to try and avoid, and would be unambiguously bearish for both economic growth and risk assets. So we're particularly concerned about that within Europe, keeping a very close eye on it. But of course, so much of it is really dependent on the outcome of the war. It's very difficult to say where we're going to be in a few months. I think maybe the last point that I'll kind of make, a broader theme within central banking, is that central banks generally profess to be very data dependent and try to be flexible in their approach to tackling high inflation. But inflation forecasts have been very poor and quite unreliable over the past year. So in effect, trying to be data dependent at the same time that your forecasts have been very poor means that forward guidance has been shifting quite a bit. And that certainly was impacting markets in January as globally central banks turned much more hawkish than they had been even a month prior. And unfortunately, markets just don't like that. So I think this latest crisis isn't making things easier. But hopefully, if we do have a negotiated ceasefire, if commodities come down, and are on a more stable footing, that will certainly make the policy path more certain and more stable going from here.
Okay, Jake, I see that the time is flying by, but I got to ask you the million-dollar question. How should investors be invested in all of this? Is it already priced in your mind, or there's still risk ahead of us?
There's definitely risks ahead. And what I've been advising clients is that, anytime you're in a situation where you're facing greater uncertainty, it's the time to, not take large directional bets, particularly when what is potentially driving, pretty large movements in either direction within the market is going to be the outcome of the war. And I think that is particularly true within European markets. When we started this conversation, I laid out the fact that, European markets pulled back pretty strongly. German markets down more than 10%, but it has essentially come back to where it was before the crisis. I think we're all happy to see that, but we'd be much happier and more confident with those levels if, there was real progress towards a negotiated ceasefire. I think until we're getting closer to that day, hopefully, but until you see meaningful progress there, it's going to be difficult to look at the market with a lot of conviction that there's upside from here. And for that reason, that's why I would advise, at this point, it's really about how do I make my portfolio more robust in the face of this volatility. So one way to do that is to consider increasing your holdings and your exposure to those companies that provide exposure to the quality factor. So the quality factor has a lot of definitions, but broadly speaking, it is those companies that have strong profitability characteristics, so strong balance sheets. And over long stretches of time, they have outperformed the lower quality names, and they've done particularly well in down markets. So it's certainly an area that I think makes a lot of sense anytime you're going through a volatile period like this. Now, I will also say, and these will be my last 2 points, I promise, that it makes sense to go back to investing first principles anytime there's a lot of market nervousness, and certainly even before the Russia-Ukraine crisis, there was a lot of nervousness in the market because we're going through a pretty rapid regime change from post-COVID boom to a tightening monetary policy cycle globally. But first things first. Knee-jerk responses historically are not going to benefit you in the long term. Being very myopic and not seeing beyond the next couple months is unlikely to play out well for you. And secondly, just a reminder that diversification is your friend, and that's not just across sectors within your domestic market, but it's across geographies globally. It's across asset classes, and fixed income has certainly been beat up quite a lot in recent days, recent times. And there's certainly, I think, headwinds to fixed income from here, with the rate environment likely to continue higher. But you don't want to forget that historically fixed income has been an important diversifier to equities. And given how much volatility we're seeing within equities, it's certainly not a good idea to completely give up on your fixed income exposure. So I appreciate the time.
Yeah, I would tend to agree with you on that one. There's certainly a lot of things that can happen over the next couple of months. Jake, that's all the time that we had today. Thank you so much for being with us. Just as a reminder, Jake Joly was a senior investment strategist with BNY Mellon Investment Management. Thank you, everyone, for being with us, and we'll talk again pretty soon. Thank you again.